Well, thanks for joining us today. Happy Friday to you. And as Christina mentioned, happy last day of summer. A lot of folks would say good riddance. But anyway, welcome to fall tomorrow and over the weekend. So I, for one, am kind of looking forward to that, my favorite season. Anyway, so glad you could join us here this morning. I am joined by Brian Hoops. Now, he is the president of Midwest Market Solutions. He is in Springfield, Missouri, and he joins us right now. Okay, I want to take a look at this overnight trade here, Brian, and we'll focus on the grain sector to take a look at how many of the contracts were higher, how many were lower. So let's go to the corn board first. Here are the quotes provided by Bar Chart. And you can tell that it was pretty flat. We were a little bit softer. December down a half cent at 4.74 3/4. March was down just 1/4 cent. So chalk that one up in the bearish column, I guess, slightly. Soybeans, they went a little higher. November up 6.5 at $13.25 cent. It traded as low as $12.92.5, as high as $13.03. So it's doing that high wire act right on $13 on that benchmark here. We'll see what it wants to do after the open. Now in the wheat trade in Chicago, December was two higher at 5.77 3/4, pretty quiet. In Kansas City, you had December 2 3/4 higher at 7.13 1/4. That was about 3 cents off of its overnight high. In Minneapolis, wheat December was 3 3/4 higher at 7.71 1/4. So it looks like in general, if you exclude the corn, we have just a minor little bounce after the washout that we had yesterday. In the cotton market, same story. December up just 13 points. It's at 86.60 here this morning. So Brian, let's talk about this here. The grain market really took a beating. It just got a drubbing yesterday. And of course, now we're ramping up our harvest activity, as you mentioned. Now what do we do here? I mean, this is kind of a modest bounce overnight. Do you see maybe this is just a temporary correction on a bigger downward move for a while?
Good morning, Marlon. Yeah, we talked yesterday morning before the opening about U.S. dollar surging higher and really not any strong fundamentals to offset it. And that's kind of the same thing this morning. The dollar is at contract highs again this morning, up a little bit. It's not surging higher like it did yesterday, but it is firmer here, and that could play a role in today's activity. We talked yesterday that probably the fund managers would look at the markets and think that they needed to have some sort of risk off session, and I think we're in a situation here now where small technical rallies are going to the trade. We are looking at very little fundamental support underneath these markets from the standpoint that demand continues to remain slower than a year ago, and don't know that that's going to change anytime real soon. So we could have a 1 or 2 day bounce, certainly, especially with some harvest delays. Western Corn Belt this weekend. I'm actually in Yankton, South Dakota, and we're seeing rain here this morning, and that is expected to continue throughout today and through Saturday, all the way from base.
It looks like we're having some communications issues. I do want to take a look at the crude oil market too. We just saw where the U.S. dollar index value was up about 100 points. Let's take a look at West Texas Intermediate crude this morning. I know Scott and I have been talking about this quite a bit here lately, how inflationary that crude oil is as far as a symbol. The November contract now up $1.09 again this morning. We're now at $90.72 per barrel, and we did have a high of $91.13 overnight. And then what's been a big concern for our farmer producer listeners and viewers out there, if I can get the right one, let's go to heating oil. This is how they trade diesel fuel on the futures market. And I see where, again, this morning, now it is up about 1.7 cents. It's at 338.5 per gallon right now. As it continues its overall upward trajectory. Now, if you take a look at the chart here, you can see what I'm talking about. Look at where we were back in June at the bottom of this chart. And since then, we have added at, about $1, I guess. If you go to the 6 month ago level, we're up 81 cents, but we were lower there in June. So yeah, right around $1 off of that earlier low. So it makes it kind of tough out there to make ends meet when you have that kind of input expense on the energy side on your farm operation. Just wanted to point that out. It's higher again this morning. We'll pause here and we'll come back, and hopefully we'll be able to talk with Brian Hoops, and we'll talk livestock after this. All right, I think we have everything reestablished with Brian Hoops of Midwest Market Solutions. Now we're going to talk about our livestock side, and today is a somewhat big day because today we'll get the cattle on feed report, right, after the markets close.
Yeah, we will, Marlon. Good morning again. Hopefully you get those technical issues corrected. Cattle and feed coming out 2 o'clock Central Time. It looks like it could be a friendly report here with on feed supplies placements less than year-ago levels. So that's kind of what the focus, I think, of the market's going to be on. Last month, we had a surprise in those placements where they dropped off sharply compared to the estimates. And that, again, is probably where the surprise could lie for this report. So I think a lot of traders will be keeping an eye on the on-feed numbers as well as those placements looking ahead to today's activity. We saw a little bit of cash cattle trade developing yesterday, pretty much steady with a week ago. I would say next week, calls are going to be dependent upon that cleanup trade today, the cattle on feed report, but also these packer margins, which are about negative $50 at this time. And that's going to be tough to see any stronger cash trade next week.
Now, what we're looking at on the screen, if we can bring that back up, is it's a table of the average trade guesses. And this is done by the Wall Street Journal. They do a survey of analysts around the country. And Brian, your company is one of them included in that survey. The average trade guess for the on-feed number is 97.8% of a year ago. In other words, a little over a 2% decline. Placement's 94.8%. Marketing's at 94.4%. I see, Brian, where on the placements, you're actually, I think you guys are about the highest one. Why is that?
Yeah, I just kind of feel that, a lot of these cattle are going to be taken off of that grass that they were on. They maybe were extended because of some additional rains that fell in August, but probably wouldn't be pulled off of those grass and put it back into the feedlots. The margins are still profitable for the feedlot operator if he can go out and hedge himself at a profitable price level. Corn prices coming down. It's time to put those cattle into the feedlots and have some good gains here. So we're looking for placements to be down compared to a year ago, but not as much as what the trade is expecting. So
just to review, we did have a hard down day yesterday, just like in grains. We had that December contract yesterday down 202 at 189.50. Looking at the feeder cattle trade, when we wrapped up the session, October was down 280 at 257.77. Wow, that was a big drop everywhere. Lean hogs were down hard. December down 375 at 74.47. So $3 off of its high of the day yesterday. All right, Brian, we'll try and be patient and be prepared for whatever happens in that report today. Thank you for the help. Brian Hoops of Midwest Market Solutions. He's in Springfield, Missouri, usually on the road today.